it sort of takes me back to what Solomon said on our air in Davos earlier in the week, is that they did bite off a little bit too much. What did you make of this journal report?
Well, growth in consumer at Goldman Sachs has been some of the worst predictable destruction of shareholder value that I've seen. I mean, 5 years ago, Goldman shouted from the rooftop about the abilities of their new consumer banking, reimagine consumer banking, the 21st century digital banking store, disrupting with their modern tech, and they hyped it. The ex-CEO, Lloyd Blankfein, made a lot of noise. He made actual calls to individuals. I never liked it. I repeated that I didn't like it. Shareholders didn't like it. And now you see they've had losses for years. They're restructuring the business, and the regulators are looking at their controls. Now, Goldman Sachs has not confirmed the report in the Wall Street Journal, but in any event, this whole consumer expansion is just a sideshow. It's 3% of the firm. Center stage at Goldman is the legacy 150-year-old business of banking and trading. That's 70% of the company. They're killing it. Best in class, and they've gotten better. They've grown twice as fast as peer over the last 3 years. So it's a shame that 3% of the company can tarnish, what otherwise has been a really good story for the last 3 years. But the bigger story here is that, hey, by the way, it's not so easy to start a bank and compete against the incumbent banks. By the way, there's a lot of fintechs which are reducing headcount. They were going to, crush the banks. I mean, there's a lot of regulation, controls, and compliance. And, first, do no harm, to, your reputation. And this is one more reason why the large banks, are looking very attractive here. And, Carl, as of the end of today, the bank stocks have, outperformed by a little bit the S&P 500. One more reason why we love Bank America, and the moats around their businesses are strong. We love the regional banks like PNC, U.S. Bancorp, Truist, Regions, KeyCorp. Even Citigroup has surprised me. So let the traditional banks do traditional banking, and let Goldman Sachs do what they've been good at for 150 years, and that's Wall Street banking.
Right. Well, finally, Mike, I remember a year ago you were railing on expense growth at, for example, J.P. Morgan. Do you think they've gotten collectively more religion about managing their headcount, their compensation per employee, and all that?
I think it's to be determined for J.P. Morgan. They still are having – look, they had record revenues, but they also have record expenses. And more than ever before in the past, they're spending and hurting near-term efficiency to gain market share. It might work, but for me, I'm taking a more wait-and-see attitude versus those that are taking more of an incrementalist approach, like a Bank America or the other banks that I named, which I think should grow revenues far outpacing expenses this year, whereas I'm not so sure that's the case J.P. Morgan now. So maybe long-term, but not right now.